Welcome to another episode of Retire Right. I'm Ryan Wyatt. Today I'm joined by Ron Wyatt and Nick Lewandowski. No funny nicknames today. I couldn't come up with anything soon enough. But both, all three of us are wealth advisors here at Wyze Wealth Advisors. Nick and Ron specifically are on the investment committee together. The topic that we're focusing on today is quantifying the value add of a competent advisor, and we'll kind of explain what a competent advisor looks like. There have been studies done on, again, what a competent advisor, the amount of value that they could add. We'll talk about the things that they're doing to add value, some misconceptions. We'll even talk about really some things that you should look for if you're interviewing advisors, kind of like the right things to look for or questions to ask. Gentlemen, how are you today?
Doing great.
Anything you want to add before we jump in?
Nope.
So I feel like this is just a good time to do this episode, and I know there's a lot of volatility or unknowns in the market, which is when people tend to maybe think of their advisor. One thing that I want to just highlight before we jump in is, when people think of financial advisors, I think there's a pretty common misconception, and that misconception is that, and this was born from somewhere. I don't know if it was in the earlier days when there were brokers that would just pitch stocks or whatever. But the misconception, I think, is that the advisor's sole purpose is to continuously beat the market. That's what their job is to do. Why would you guys say that you think that's a misconception?
I think our job primarily is to achieve our clients' goals. Okay. That's our objective. Now, a secondary objective is, yes, we would like to outperform. There's no doubt about it. Okay. Mm-hmm. And, the way we do things is really data-driven, has been proven, and we think it can continue. But there's no guarantee of that. But I know we can add value by having a really good plan.
Okay.
Yeah, no, I would agree. I think it's not so much as investing is not actually important. It's super important aspect of the financial plan.
It's your driver.
Right.
It's a driver.
It's the engine for returns. But the value add that a good advisor can, and in our opinion, should provide is much broader than just narrowly focused on, we like this stock and we think it's going to do well.
What, if you have an advisor, or I guess if that just focuses on consistently beating the market, or maybe if you're interviewing advisors and that's something that you're solely looking for, what are the challenges in consistently just beating the market?
Well, to beat the market, you have to be different than the market.
Okay.
And when you're different than the market, it introduces something called tracking error. All tracking error is that, when the return of the market's up, are you, up 2? When the return is negative, are you negative 2? How closely do you track the market? And again, to outperform, you have to have higher tracking error. I mean, you don't track it exactly. And so there'll be times of great outperformance, and there can be times of underperformance. When you have underperformance, if you believe in what's being done, you have to stick with it so that you have a chance to have those periods of outperformance, and hopefully during the full cycle, there's outperformance.
Okay. So I think that's a pretty fair point. So within that, there's probably a lot of when you think about investing, there's a lot of things that you can control and there's a lot of things that you can't control. Maybe, if you don't mind, could both of you just highlight some of the things that you can control when it comes to investing?
Yeah, sure. So the biggest one, or I don't know if you'd say it's the biggest, but in my mind, one of the biggest ones is one of the things that's directly in our control is how much risk we take in the portfolio. And in my mind, that's almost like, I'm reaching for a metaphor here, but think of it, if the portfolio is your engine, how much risk you take is almost like how powerful you want the engine to be, or how fast you want to drive, along those lines. And it might get you to your destination faster, get you to your destination with more money, obviously, in the case that we're talking about, but the ride can be a lot rougher, and, there's potential to kind of spin out along the way at times if you take more
Got
risk.
it.
Yeah, and so I look at it in not just investments, but in a bigger picture, which is the levers of a financial plan, right? So you can look at how much you're saving, as Nick said, the risk you're taking, your allocation. You could look at when you're going to retire, earlier or later, how much you want to leave to people. And then I think I mentioned about how much you're investing. There's one more I'm missing, the 5 levers.
Spending, saving.
Yeah, spending. Yeah, how much like in retirement you spend. So those levers are literally what you and the advisor can control.
Yeah.
Okay. What happens with the economy growing or slowing, inflation going higher or lower? We don't have control over.
Yeah. And the other thing that I would want to say too is, I had a conversation. I was having a conversation with a client the other day, and concerned about the volatility, what's going to happen with tariffs, all that stuff, and there was some comparison going on between her portfolio and some friends' portfolio. And basically what I found out is that her friends were in 100% stock, S&P 500, and she's in more like a pretty conservative retirement portfolio. So you can't like compare your situation to somebody else's. Like a good advisor is going to know what your situation is, and to Nick's point, be able to talk to you about, hey, how much risk do you really need to take to achieve your goals? Like, you don't want to run out of money, right? So do you need to be in a 100% stock portfolio? Probably not. Where's that balance? So that's just something else I think that would be worth highlighting. Ron, I think this point would be particularly relevant for you to share, just 30 years in the industry. Can you maybe walk us through like when that transition from brokers and stock picking to comprehensive financial planning took place, and maybe like why that started to become?
So I made that transition in the late 90s. The industry didn't make it until well after that. I would say
put your cufflinks and your white collar shirt with the blue stripes
exactly. I was at the time. I was at a company, First Union, that became Wachovia, that became Wells Fargo, and they gave us bonuses if we had financial plans. I had everyone on a financial plan already, so
yeah.
I didn't have to do any work. I was already doing it.
Yeah.
But the industry is probably 10 years later than that, and now it's become a little bit more of the norm. But the depth of what they're doing, a lot of people is not very deep at all.
Okay, so I think that's a good like highlight on, again, the misconception of an advisor's role, and again, that misconception is that their primary role is to beat the market consistently. What we're going to talk about, and again, I don't want that to sound like that's not a goal of ours. We are trying to do better than the market, but that's not our sole goal. What we're going to do right now is break into what the core components of the areas that, again, a competent advisor is really adding value. And for each area that we talk about, what we'll do is either share a story or just kind of explain what that is and why it's important. So one of the just low-hanging fruits that I think of first is just asset allocation. And I know we've maybe briefly hit on this, but let's just expand a little bit further. Why is asset allocation important, and why is that an area that an advisor could be adding value?
Nick, you want to take this?
Yeah, so I think asset allocation is like almost like once you have the financial plan.
Also, sorry to interrupt. Could you just define like asset allocation?
Oh, asset allocation. Yeah, asset allocation is like in what proportion do you own different types of financial assets? So what percent is in bonds versus stocks versus cash, and so on. It's not the I own Apple versus whatever else, on a security level. And it's so important because once you have the plan established in terms of the goals and what needs to be funded and all that, the asset allocation really allows you to set the level of expected return and risk for the portfolio in broad strokes. So that and the asset allocation proportion is one of those things that we definitely have 100% control over. Hugely important. And I think sometimes it gets lost. Like, to share a little story, we were actually talking to a client yesterday who was very concerned about the current environment. We're getting a lot of these calls right now, as you might guess. It tends to happen. And I think one of the things that happens, like you were kind of alluding to it already, already. People look at like the index numbers for the S&P or whatever it is, and they see those numbers and aren't necessarily translating them back to like what their particular asset allocation is. So with our risk software, we were able to look at his specific asset allocation and actually show him different scenarios. If the 2008 financial crisis repeated with your portfolio, like you would be down, sure, absolutely, but not nearly as much as in his mind he thought he would be down.
Yeah.
So that's just one area. I could talk about asset allocation for hours, but that's just a taste.
We have a unique bet on it too, that we do this all season strategy, and I'm not going to go in great detail. We did a podcast on this already, but basically, the economy, based on what's happening in Washington, around the world, it could hurt or help the economy. It could cause inflation to go higher or lower. And so what we do is we have asset classes in different segments of the market, so that what we're trying to do is, no matter if inflation is higher or lower, the economy is stronger or slower, that we're trying to give people a smoother ride. That's it.
Got it. Another thing that comes to mind is just like being cost effective, just especially with your investments, like cost effective implementation on the investment side. Can you guys talk about why that's so significant?
Sure.
And really an important area of where an advisor is going to add value?
Sure. If you look at it, if you see our investment presentation, the second part of it is investment basics, which is basically like a free lunch, right? So
what do you mean by that? Investment basics, basically like a free lunch.
So if you reduce cost and you reduce taxes, that's pretty much a free lunch, right?
Meaning you're giving yourself better returns.
Right.
Same level of return, but you reduce those running expenses.
Exactly. You reduce expenses, you get a better return, keep more in your pocket. That's basic. The other thing is like diversification, right? That's basic stuff that we do initially in setting up a portfolio.
Got it.
And so cost is extremely important. A lot of times when you see so-called like active management versus passive or index, active management will mainly do worse just because of the higher fees. Fortunately, our portfolio, we don't have to worry about that, but most of them do, right?
Yeah, I agree. I mean, and when we talk about cost-effective implementation, what would you guys say like the weighted expense ratio is for our ETF portfolio?
Between the pure equity portfolio would be between 15 to 20 basis points. That's 0.15% to 0.2%, somewhere in that range.
Yeah. So,
and that's global, including emerging market, large and small. It's very diversified.
So the reason I ask that is just to give some numbers. So if you, and I really do, like the more people that we talk to, I think that this is something that's not very well known. Mutual funds tend to be higher cost, especially if they're actively managed, like you said, Ron. You could have a mutual fund portfolio that the costs don't factor in what you're paying your advisor, right? If you're paying your advisor 1% or more and they're using mutual funds, the cost on that portfolio could be 0.5%, maybe even a full percent.
It could be easily full.
Yeah.
I mean, a lot of them are
3, 4, 5 times the cost of our ETF portfolio, depending. I'm not trying to bash mutual funds. That's just a reality of where the average expenses shake out. And
so what happens is that if the cost, let's say, of your mutual fund portfolio is 1%, that's just that 1% is never going towards your returns. You're starting off the year 1% down. Your mutual fund has to, whatever it returns the rest of the years. Right. And the other thing is too is the mutual funds are tax inefficient compared to exchange traded funds. So there's a tax drag component that also lowers returns. So when we talk about cost effective implementation, that's what we mean. It's using quality but low cost investments, so more of your money is working towards your returns. And then also you need to factor in tax efficiency as well, because the higher the tax inefficiency is, the lower your overall net return will be. If you guys don't have any other points that you'd want to add on that, the third part that I would say is the ongoing rebalancing is another area where, again, an advisor is going to be adding value. So what's the value add there? Why is it important? How's it done, et cetera?
So, broadly speaking, when you think about trading, like when do we buy, when do we sell, there's a couple different ways to approach it. 2 ways, broadly speaking. First way, you can say, I'm going to predict the future, and based on whatever my genius or my method and what I think is going to happen in the economy and the market, now's a good time to buy, now's a good time to sell. We don't think that method has a very good track record. Like if you look at the data, we don't do it that way. We prefer to do the other way, which is like a systematic approach. And so we set targets in the asset allocations for our asset classes, and then we have targets for the individual funds and securities we own in our strategies as well. And subject to different thresholds, when something does well and it runs up past its target, goes higher, we sell it high, and then you take those proceeds and buy the things that haven't done as well to buy them low and get back to target again.
And like if you could summarize that in kind of like a sentence or two, like what is the end result of doing that?
Yeah, so if you're in a pure equity portfolio, what's happening is that as one area of the market, say in the late 90s, tech stocks get expensive, right? So think of it as a rubber band gets stretched. As an asset class gets more expensive, people are very excited to own it. They want to buy more of it because the price is going up. But the problem is the expected return goes lower as an asset class gets more expensive, okay? On the flip side, if you have an asset class, and let's assume we're talking about quality asset classes, proven asset classes, okay?
Yeah.
And it goes down relative to the other ones, right? It's getting cheaper on a relative basis. The expected return starts getting better. And so what we're doing is we're basically trying to trim, not sell the whole, but trim high and add low. And what that does over time is a couple things. One, it can help with return, and two, it can help with risk.
It can help with risk because going back to the rubber band analogy, if you don't do anything, that rubber band gets stretched and stretched, and all of a sudden when it has to go, that's going to hurt a lot more. But if you maybe cut it off,
right,
it's not stretched too far.
Don't stretch it too far, right?
And then all of a sudden it's a smoother ride,
yep,
not as volatile.
Exactly, exactly.
All right, so then another...
one thing I wanted to add too is most people who, Nick mentioned about trying to forecast or predict the market, most people who do that in a rear view mirror. Whatever's happened recently, they forecast into the future. So when stocks are running, they get excited and go from a balanced portfolio to more of an equity-oriented portfolio. And then all of a sudden the market goes down and they panic and they go to almost all cash.
Which is funny.
They're basically always buying high and selling low. It's not the way to do it.
The market's forward-looking too, so that's just funny. So it's like the market's basically, like what we're seeing right now in the markets, the market essentially priced that in 6 months ago. Yeah. And somebody's making decisions looking in the rearview mirror. It's like you're so far behind. It's just there's no
the worst
logic
thing to do.
It.
Right.
What about asset location? I know this is another really important area. Why is it important? Why does it add value?
Let me just give you an example.
Also, please define it, because I know asset location and asset allocation.
Right. So asset location, what that means is you have certain assets that are tax inefficient. For example, a high yield bond, or like we use private debt. The yield is 10%, which is incredible, but it's all taxable income. So if you have it in your non-retirement account, you're paying that tax all the time. So that type of asset really belongs in an IRA or a Roth IRA, tax deferred accounts.
Meaning whatever happens inside that account, it's not taxed to you. Really, with IRAs, just in general, you don't have to worry about any tax impacts, period, until the money's coming out.
Until you pull money out, right. And then anything that comes out, it doesn't matter if it was generated by stock returns or private debt returns, anything that comes out is taxable income. Okay?
From a traditional IRA, correct.
Now, if you have, like our exchange-traded fund portfolio, a very diversified, tax-efficient portfolio, then what happens is there's not much tax, capital gains being declared on you, right? So it's tax efficient. It can grow over time. In that growth, you're not getting taxed a lot every year. And so that's what asset location is. And we use it in certain situations. We don't. In certain situations, we do. It just really depends on client circumstances.
Got it. So in general, asset location is putting your tax efficient investments in your non-retirement accounts.
Correct.
And then your tax inefficient ones that are kicking out more income, into retirement accounts. And obviously, age and a lot of different factors can kind of play into what you're doing with that. But
and volatility also has a play. If something's very volatile, you trade more. That would belong more in an IRA as well, or tax.
I don't know if you guys have seen this, in your past experience in the industry, but if a firm or maybe advisor, isn't doing an asset location strategy, what does that look like? Like, what's probably the end result, for the client?
Every account has its own allocation. Like what the Roth account might be, 100% in stocks or 80% in stocks. Maybe a joint account's a balance 60-40. Each account, and overall the blend makes sense for a client, but each account is managed, individually, not as a whole. And again, we do that. It just depends on circumstances.
Got it. And so if you're not doing the location strategy, there could be a slightly higher impact tax-wise.
Right.
Okay.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
Two more things and just like the core areas where an advisor is adding value. Next one I would say is withdrawal strategy. So obviously this one is critical for our clients that are no longer working. Why is that so important? And again, like what are the things that an advisor is doing to actually add value in that area?
Yeah, the withdrawal strategy is critical because like typically this is you hit retirement in particular, and it's how are you generating that paycheck that you need to replace, right? Like where is that money actually coming from? And this is a huge conversation we have with anyone that's on the cusp of retirement. They're always really eager to have that conversation. So the withdrawal strategy has huge implications for the tax, the amount of tax that you end up paying as you're doing those withdrawals, and then also how well positioned your assets are to grow net of taxes in the future. And so it depends heavily on client circumstances, but typically what we want to see with a withdrawal strategy is we want to create what's called tax equilibrium for a client, where if you graph their taxable income over the life of their plan, we don't want to see their income starting off really low, like when their income stops and they retire,
right.
And then goes up like way high into multiple higher tax brackets at the end when their required minimum distributions from their retirement accounts get a lot bigger. We want to make sure the withdrawal strategy kind of equalizes the amount that's coming out. So we'll be hitting those tax deferred accounts more ideally when the other income is lower early on, to then bring the bracket down later, because not as much money is in the tax deferred traditional IRA accounts later on.
With our advanced software, what we can do is map out a plan, a 10-year plan plus, and it basically we can show different strategies. Do you want to take it from the IRA first, or the taxable, or the Roth, and anywhere in between? We can do a bunch of different scenarios to optimize the amount of income you're receiving in the most tax efficient manner.
Yeah, and I would say that the demographic that this is the most important for is really the individuals or couples that retire before they have to start taking their mandatory distributions, especially if you have like a well-diversified portfolio, meaning like maybe you have some money in Roth, maybe you have money that was in a 401k, maybe you have a joint account with your spouse. When you look at those three different account types, they're all taxed differently. And so you can really run a lot of different scenarios to see, hey, like, do Roth conversions make sense? I'm in these low tax bracket years. What accounts should be taken from and how much? Do I blend it? Do I just use one account? So again, it's very important to do. And the reason that you do it is long-term tax planning. And the better you do long-term tax planning, the more money that you're saving for yourself. What you typically see is that your estate grows, you can leave a more efficient, tax efficient estate, et cetera.
So I do want to add one more thing just to tie it off, and it ties back to asset location a bit too. One of the goals that we have, there's like the tax benefit during your lifetime, but we also have plenty of clients who have goals for legacies, once they pass, and that can be charitable, it can be to family, whatever it is. And by having an optimized withdrawal strategy, doing all that analysis Ron was talking about, you can set up the assets that are being passed to be passed in the most efficient way to maximize their value for your intended recipients. So there's a during your lifetime benefit in terms of your overall tax picture, and there's also potentially a benefit to charity or your heirs in the future.
To summarize, we're trying to make it more tax efficient while you're alive and make your estate more tax efficient upon death. I mean, that's the goal.
That's it. Yeah.
All right, last thing here. Just what about financial planning? Like I know we briefly hit on that.
Waste of time.
Don't do it. Only beat the market.
Why is it so important, and what is that actually doing for clients?
Well, how can you get to where you don't know where you want to go, right? I mean, you have a plan, and things are always changing, right? But what studies show is you're more likely to achieve your goal if you have a plan, okay? Because you make intelligent decisions, but also you become less emotional about the market, right? So if you're focusing on, okay, I have these goals, I understand my plan, this portfolio is set up so that it can achieve my goals and I can sleep at night where the risk level is appropriate, right? When the market fluctuates, or say we get into a bear market, it's easy to panic. I mean, we're not immune to it.
Right.
But when you focus on the market, the daily fluctuations of the market, or watching the stock market go down, it's easy to pull out. But when you have a plan and you understand how everything fits together, studies show, and my experience shows, that people stick with the program longer. And really what it comes down to is do the right thing long term and you'll have a great retirement.
Got it. So why would you say, you said something in there specifically, it was along the lines of it'll allow you to kind of settle down whenever the volatility enters the market. Could you maybe just expand on that just a little bit? Why does the plan give you that extra level of comfort? Is something going on in the plan where it's essentially showing, hey, there's going to be times when the market's doing poorly, or expand on that?
Great question. In their plan, we can actually show a couple different ways. One on the portfolio level, and the other one, Nick had mentioned this earlier, on our portfolio level, we can show how it's acted during different bear markets. But the plan, we can run scenarios. What happens if the market drops 20%? What happens if Social Security is cut? What happens if inflation's higher? We can show you all these different scenarios so that you know ahead of time what could happen, and if it happens, what's the probability of success, right?
Yeah.
So people, when they understand that, when people understand it can happen, and most of it will happen, by understanding and having that plan, focusing on that, not, again, the market, you're better off.
Yeah.
This might be putting the cart a little bit before the horse with topics that we might cover later, but Ron actually had a really good kind of mentoring conversation with me yesterday after a meeting, and was saying, when clients are worried about volatility, when people are nervous because of what's going on in the world, a lot of it boils down to a feeling of loss of control, based on what's going on in the world. And we talked about how there are these big important things like what's going on in the economy, what's going on with inflation, that we just don't control. We just can't control.
Like tariffs, right?
Yeah, there's nothing that you or I or Ron or anyone listening to this can do about any of that stuff on their own. But when you have the plan and you relate the plan back to those levers that Ron was talking about, and you can run all these different scenarios, you begin to restore some sense of control to someone in terms of taking that focus, way back what we started on at the beginning of the conversation. You're moving it away from the fear of what I can't control, which we can't do anything about anyway, back to okay, how can we have a constructive conversation and restore some sense of focus on the things that we can control to improve outcomes?
Right. During the 07-09 market, I learned a lot from that. And as it progressed, some people would say, hey, I want to get out. And instead of saying, you can't, I would say, oh, that's a possibility. Let's take a look of what that means to your long-term future, right?
Yeah.
And so if we take your balanced portfolio and just make it a little bit more conservative, what does it mean? And what's funny is most people stayed very similar or made slight adjustments, but they felt in control. And because they felt in control, they were able to stick with it longer term.
I'm glad you brought up that point, yeah, because it's really financial planning, I would say, done wrong is, volatility enters the market. You have a plan in place for your clients, which is good, but you're, whenever they come into the office and they have a meeting and they're concerned, and you just say, "Oh, stay the course," it'll be, that's not advice. What is financial planning is saying, like you said, Ron, it's, okay, what are the options here? We could sell out. Let's show you what that looks like. We could stay how we're currently invested. We could take less risk. Maybe if your probability of success is dropped, we could talk about spending more. There's a bunch of different
spending less.
Sorry.
Yeah, right, exactly.
There's a bunch of different options. So it's just showing you what those options are, and then really through conversation, the client's going to end up knowing which scenario they're more comfortable with.
Right. We want to help
and then
people.
they've made the decision too.
Right.
So
we want people. We want people to make educated decisions. We want to lay out, if you do this, this is what it means to you, right?
Yeah.
So that less emotion, more logic, more long term.
That's a perfect segue into well, let me recap first. So like the core components of what we think where an advisor is adding value is the asset allocation, like the mix between stocks and bonds, being cost effective with implementing the investment strategy, rebalancing. I mean, that's just a
Table
necessity.
stakes. Yeah, it's table stakes.
Asset location when necessary. Again, that's dependent on a lot of different factors.
Right.
Withdrawal strategy, critical. You need to know what you're taking from what accounts. It has to fit into your overall long-term tax plan. And then again, financial planning. That's just, hey, where are you at now? Where are you going? And when things happen along the way, what options do you have?
And you can't really do any of those other things without the plan anyway.
Right.
And one thing that's really interesting, the plan will show you that when the markets are lower and your probability drops a little bit, one alternative is to get more aggressive when it's cheaper. That's when you should. And the plan will also show you when the markets are doing really well and everyone's excited and they're jumping into AI stocks. The plan will say, hey, if you want to, you're overfunded. You have more resources than you know what to do with. Do you want to take less risk as an option, right? Those levers you get to control.
Yeah. I just really like it because it uses numbers to answer questions and it like eliminates doubt.
Right.
That's the perfect segue into like the strength or the impact of like behavioral coaching, which I think is another big part of what advisors do.
Why don't you start with whatever this question is going to be? You can start because you have 30 years of behavioral coaching expertise. You've been on the whole journey.
I'm a PhD. I'm a therapist. I'm so good at this. So
I don't know if you asked a question yet.
The problem is most people don't think it adds any value, the behavioral coaching, okay? But it is extremely important. So let me just give you a story. So I was hired by a couple. The gentleman worked at a local bank in the trust department. He's a CFA. And so he was able to do this on his own, not so much the planning.
Chartered financial analyst. That's like the investment equivalent of like a CPA or
for the taxes, right? Yeah. So he wasn't very well versed in the planning, but he understood investments. And I said to him, "Why do you want to hire me?" And he said, "Because when it's my money, I get emotional." Okay, and he was right. So in the late '90s, we had a very balanced portfolio. In the late 90s was the hardest time in my career for me because I didn't get sucked into the tech bubble. And so for that last year and a half, 2 years, I was underperforming a little bit because I didn't want to get, sucked into the mania, right? So he calls me and says, "Ron, are we being aggressive enough?" Okay. This is the conservative guy that every time we get together is making sure the risk is okay. And I said to him, "Yes, you're fine." Okay. So I get him through the 2000 to 2003 bear market, like in really good shape. Because the first 2 years of that bear market was just really tech only. And we had some, but like I said, we weren't overexposed by any means. So now we come up to the 2007 to 2009. So most clients, once they've been through a full cycle with me, realize, hey, this stuff works, right? Being diversified, focusing on these factors that work, rebalancing, right? And so 07, 09 comes, and now he's on the other side. Should we reduce risk? And we already had his risk pretty low. And we made, some tweaks. But after the market ended, when it started to rebound, he finds religion. And he's looking at talking to another firm. They're recommending tactical allocation funds, right? So they're what basically is market timing, and they're very expensive, very tax inefficient. And he's comparing notes with me. And he's like, "Can you do this?" I'm like, "I don't believe in it, so I can't do it." So we decided to part ways. So what's so funny is the Wall Street, big broker dealers, they produce products when people want to buy them. Yeah. And the worst time to buy that tactical allocation fund is after the market has gone down, because then it is so cheap it recovers nicely, right? Which it did. Over the next 10 years, the returns were incredible. But he missed it almost all because he was in a fund that wasn't going to participate. And so it is so important it's not funny.
And it just ties back, like if you listen to that story and you map that onto all the things that have come previously in the conversation, there's the emotional component overriding the fact that he has like the premier investment analysis education designation. He knows the numbers, he knows all the data, but still can't override his emotions. And also the component of driving in the rearview mirror that Ron talked about right at the start. That driving in the rearview mirror thing is such a problem for getting good investment results. And the investment, the productization in the investment industry, I cannot underline that enough. I mean, I came into this industry after the 2008, 2009 financial crisis. I missed the dot-com, a little bit younger than the master here. But at the time then, the investment landscape was littered with these, you don't want to own stocks. Get away from stocks. Stocks will never return.
After they're cheap, yeah.
And you've seen the run over the 10 years from like 2010 to 2020.
It was incredible.
The COVID area was incredible. So, that story is a perfect encapsulation of everything we've been talking about with that behavioral aspect and the importance of being disciplined and sticking to a plan.
Yeah. And I mean, there's a million different things. Some people have different behavioral biases. I forget when we talked about it. We might have even done a podcast, but there was a study that was done on like sentiment around the overall economy or the market based on your political views. And so it's like if you lean conservative or vote, Republican, and there's Republican in office, you tend to think, the economy's doing pretty well, even if it's not. And then vice versa. And so there's a million different things, but again, don't get wrapped up in that. Go back to the plan, because the plan, you can paint, whatever what if question you have, you can paint that out, and then the client is going to see there's a clear answer for them they're going to resonate with. Right, and I'd say that's kind of the power of the behavioral coaching part there. So what's the takeaway with all of this? So again, I say a competent advisor, because we think like for an advisor to be, again, competent, they really need to be focusing on all of these things and, have processes and, define investment beliefs where they're implementing these things. Like, they have to have processes to implement and test what a client's risk tolerance is so they can come up with the allocation. They need to have a comprehensive plan because that relates to the allocation. The behavioral coaching, that's just something when you care for your clients and you've been doing this for a while, that kind of comes with the role. But when you're doing all these things and doing them well, while it's no guaranteed rate of return, studies show that an advisor can add up to 3% net of returns on top of your overall like portfolio returns.
This is Ryan's quoting a study from Vanguard called Advisors Alpha. So you need to just pick that out of clear blue. There's a study by Vanguard that they specify it, right?
Most advisors.
I think it's more 10%, but
I was gonna say most advisors add 3%. I think we do like around like 35%, something like that. But no, it's none of those are guaranteed returns. It's just a comprehensive study that's been around for a long time. Let's just conclude with just maybe a couple quick points on like if you're trying to find an advisor, what are some things that you should be looking for?
Well, they look like us.
I was going to say Google Wyze Wealth Advisors.
Just have a plan, right? Then make sure it's tax efficient and make sure it's a logical investment strategy. I mean, to me, that's it. Anything that you would add?
Yeah, I mean, I think a big thing is, we act as fiduciaries, which means we're obligated, like legally, to act in the client's best financial interest, which is like kind of like the highest level of standard of care that can be applied to an advisor-client relationships. Not everyone in this industry. We've talked about the difference between like brokers and what we do as advisors. Big difference is that if you're just a broker, you're bound bound by a less stringent standard. It's just the suitability standpoint. There are plenty of things that are suitable
that aren't necessarily good
in terms of it's something you're able to own or buy that is suitable, that are not in your best interest to own. So always asking that question, are you a fiduciary, is a huge one. And that's like a very simple thing that you can verify in documentation.
Yeah, and on top of that, so I mentioned the 3 things that we do. Fiduciary standards, very good. And fees need to be reasonable, right? You want to make sure that they can add value for what they're charging, and we strongly believe we do.
Yeah, and the last thing that I would say too is that, like, again, the fiduciary executing on everything that we've talked about earlier. Again, I know we said it a couple times, but that's just like that box just needs to be checked. The other thing that's really important to think about too is, like, do your values, do your communication styles, do those align? Like, can you sit down with your advisor? Are you comfortable with them? Are you willing and able to share, stuff about your personal financial situation with that advisor? If you're not comfortable, it's probably a red flag. We would hope, if a client hires us, that they're pretty comfortable because we're comfortable with them. But yeah, so we hope you found this episode informative. Again, a lot of this is based off the Vanguard Advisor Alpha. That's a study that's been going on for
it's over 10 years.
Yeah,
I think,
for years. I know when I worked back at Vanguard, I think they had a copy out then. So if you find this content interesting, please give us a like on YouTube, subscribe to the channel, whether it's Spotify, Apple Music. And if you're interested in learning more about our firm and what we do, just check us out online, www.wyzewealthadvisors.com, and Wyze is spelled W-Y-Z-E. Thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.